All right, so you have these little acquirers inside the group that know their niches really well, and they keep their authority in terms of decision making, and they'll help find new M&A targets essentially. But I do think it would still be helpful to zoom out for a second, because underneath those platforms, there are these bigger themes that Chapters is investing behind. And so they keep talking about public, enterprise, and financial technologies as the three core segments. So maybe you could just walk us through what that actually means in practice, what kind of businesses sit inside each of those segments, and why are these the areas that Chapters wants to double down on specifically?
Yeah, I mean, as you said, generally speaking, there are these three different parts of the company: the public sector segment, the enterprise segment, and financial technologies as a whole. And the public sector currently makes up about 45% of revenues, enterprise is about 30%, and then financials is the rest of that business. Peak Mobility is a good example for the public segment and the kind of company Chapters wants to own more of. Peak Mobility is a software developer for public transportation companies with more than 40 years in the business. So their systems handle real-time operations control, depot management, e-bus charging, dispatching, and basically all the behind-the-scenes logistics that keep buses, trams, and metro systems running, which is basically the heart of every major European city. So whenever I hop on a bus here in Hamburg, the reason it's charged and on time, when it is actually on time, is because software like theirs coordinate the entire process. And they sell these systems to pretty much a whole range of major transport operators across Germany, but like I said, also Switzerland and Austria. And these are exactly the kinds of companies that just fit very well into Chapter's playbook. They are part of critical city infrastructure. The barriers to entry are extremely high, and customer relationships last for usually decades. And if there's one thing that Americans should know about Europe, it's that there is no shortage of regulation and bureaucracy. So switching core public transportation software is probably the biggest nightmare that could happen to every party involved in such a transaction. And yeah, it's another one of those businesses with just strong long-term tailwinds, because as I said, public transport is becoming more and more important each year, and it just continues to grow.
Even Einstein had blind spots. That's why modern science is built on the idea of peer review. Investing may be more art than science, but that doesn't make peer feedback any less valuable. The tricky thing is finding qualified people who are interested and willing to help vet your investment ideas. That's why we built the Intrinsic Value community. It's a place to connect, share ideas, learn, and get feedback. Nobody ever wishes they'd spent more time buried in spreadsheets, but connecting and building relationships with others who may be smarter on a topic than you, but who are also schooled in value investing, that's valuable. We make spots in this exclusive community available in cohorts every few months, and last time around, our 30 available spots filled up pretty quickly. If you're interested in our next cohort, which will be even smaller, you can join the waitlist at theinvestorspodcast.com/intrinsic value community. That's theinvestorspodcast.com/intrinsic value community. Support for the show comes from Public, the investing platform for those who take it seriously. On Public, you can build a multi-asset portfolio of stocks, bonds, options, crypto, and now generated assets, which allow you to turn any idea into an investable index with AI. It all starts with your prompt. From renewable energy companies with high free cash flow to semiconductor suppliers growing revenue 20% year over year, you can literally type in any prompt and put the AI to work. It screens thousands of stocks, builds a one-of-a-kind index, and lets you backtest it against the S&P 500. Then you can invest in just a few clicks. Generated assets are like ETFs with infinite possibilities, completely customizable and based on your thesis, not someone else's. Go to public.com/TIVP and earn an uncapped 1% bonus when you transfer your portfolio. That's public.com/TIVP. Paid for by Public Investing. Full disclosure and podcast description. Just like everybody else, there was a time when I was a beginner investor, and I have to say, investing is particularly filled with jargon that can just make it so difficult for new investors to understand what is going on. But it's never too late to get smarter about stock investing from the ground up. At the Investors Podcast Network, we've made a habit of studying the world's best investors, and now I'm distilling those learnings into a simple course for you, or for anyone in your life who you might want to share the gift of knowledge with. With my How to Get Started with Stocks course, you can master the principles of excellent lifelong investing with valuable insights for both beginners and pros. The course covers 10 different sections, beginning with the basics of what a stock actually is and how the stock markets work, to strategies to optimize your retirement savings, how to pick great companies for the long term, what to look for in ETFs, and how to monitor your investments, plus so much more. To begin getting smarter about investing, just visit theinvestorspodcast.com/get started with stocks. That's theinvestorspodcast.com/get started with stocks. And for a limited time, you can use code STOCKS15 for a 15% discount at checkout. I was actually planning to ask you about AI later in the episode and whether it's a threat to the business, and maybe we'll still get to that, but I just can't help thinking that public sector clients are probably a lot more forgiving when it comes to new innovations. And what I mean by that is, if you take a company like Adobe, they're deeply embedded in customer workflows too, but their customers are private companies, and private companies are constantly trying to become more efficient, cut costs, and shorten processes. So the moment AI becomes a viable alternative, Adobe has to deliver something equally powerful inside of its ecosystem, or customers will start looking elsewhere. And governments just don't operate that way. They aren't driven by the same incentives. And honestly, they don't face the same pressure to adopt new tools immediately or squeeze out every ounce of efficiency that they can. And so their main priorities are stability, compliance, and ensuring the system keeps running. And innovation usually takes a back seat to that. So is that actually an advantage for chapters in that they focus on the public sector as part of their business model?
I think it's fair to make that argument. I actually listened to a conference recently where Jan Moore gave a presentation. It was actually hosted by Chris Mayer, the author of 100 Baggers, by the way. And he made a really good point, I think. He said most people completely underestimate the integration part of AI. So meaning AI won't just magically come in and then replace every piece of software overnight. It will mostly be about entering the workflow through the tools and companies that they already use. So talking about Adobe integrating an AI model in their own ecosystem and then delivering that to the customer. And I mean, that's exactly what we've been preaching for months now when we talk about these companies, not only Adobe, but also Salesforce or even S&P Global recently. And the value isn't just in the AI model, it's just in embedding the technology in the day-to-day workflows where the customer already lives and actually has to transact with customers. And sure, there's going to be more true for some companies and maybe less true for other companies. But if you think about public organizations in Germany and in the EU in general, yeah, that's even more true there. I think there's a good argument to make that they're less likely to change than any other organizations. And they just rely on long-standing relationships and stability. So when AI is adopted, I think it will be through existing vendors, not by just ripping out everything that they already have and then starting over from scratch because there's a new AI startup that has a tool that's supposedly better than the legacy software.
So if anything, AI should maybe become a tailwind for chapters and not a headwind. And perhaps even more so because they are in the early stages as an acquirer and can always adjust their strategy if AI should be even more disruptive than people assume today. And if there were a niche AI tool that truly solves a mission critical problem better than what they already have, chapters could just buy it and fold it into the group. That's one of the advantages of being a serial acquirer. And so that might be more difficult for serial acquirers that already have hundreds of companies under their umbrella, thinking about maybe Constellation Software there, but it should certainly be possible for chapters. And so how does it look on the pricing side in the public sector? I mean, the barriers to entry are obviously high, and that's good. And the products are very sticky, but I could also imagine that there are all these regulatory hurdles to raising prices, right? The government doesn't want you to raise prices by 20% on them. And so to what extent is that an issue for them?
Yeah, that's actually a good point. I mean, we talked a lot about pricing in our TransTime episode, but not every company is TransTime. So you would think that governments are the last customers who would accept price increases, especially ones that go beyond inflation. But in practice, Chapter actually does have pricing power in this segment and itself talks about what they call, quote, high potential for price normalization. And the reasons I think are the ones that we already mentioned in this episode before. For example, your bus depot software or your emergency response platform goes down, everything stops. And it's a huge disaster for these major cities. So nobody in a public agency wants to take the risk of just switching vendors, retraining staff, then migrating really decades of data in most cases and dealing with political blowback if something actually happens and the system breaks down. So I would say the risk of changing products just outweighs the possibility of saving a bit of money here and there. And most of these contracts are long-term linked to regulated budgets anyway. So cities usually bake in small annual price adjustments. So thinking about inflation, maybe 2 or 3% a year. And just to keep up with higher requirements, maintenance, and compliance and software is still costing. I mean, that's obviously not explosive growth, but I could very well imagine that there's more upside than that once AI really comes into play, and maybe you have some new modules or products, and you can generally save time and money for your customers. And in that case, I think it gets a lot easier to argue or to justify higher prices or additional fees for some new features that you offer to the customer.
Okay, well, that's a pretty good look at the public sector. What about the enterprise segment? And what companies are they owning there? What are the competitive advantages, if any, in this second segment of the company?
One thing you notice pretty quickly when you go through Chapter's portfolio is that a lot of these companies have been around for 20, 30, and the company we talked about earlier, sometimes even 40 years. So for software companies, I would say that's a pretty long time. You're not talking about manufacturers that have like decades or even sometimes hundreds of years of history. So I think most of these companies are pretty well established in the niches they play in. And that alone tells you a lot of things. I mean, first, these businesses clearly have real product market fit. So you don't survive in a niche for decades unless your customers rely on you and really think the product that you offer is a great one. And the second thing is actually even more interesting because many of these companies never even use their pricing power. Chapter's CEO mentioned an example of a company where the annual recurring revenue went from about 800,000 euros to 2 million euros just by updating prices. And according to him, churn basically didn't move. So that's a pretty common theme in these older and founder-led businesses where they know they have a great product, they're good at serving customers, but historically, they're very conservative when it comes to raising prices. And that's now a big part of Chapter's playbook. And it's kind of the same thing. Once again, we talked about the trans time when Nick Howley publicly said that especially the good companies, the one with a new product and a pretty big moat, they massively underestimate how much pricing power they actually have just because of the quality of their product. And Jan Moore basically said the same thing. Founders often worry too much about losing customers and then don't fully appreciate the moat that they have built over decades and by just being the best player in the game. So yeah, you've got customers still sitting on old contracts, old price lists, and sometimes literally the same terms they signed 10 years ago. And I can repeat now what I said about the public segment, but again, it's about high switching costs and that price increases tend to work because the products are just so sticky.
One of the companies you told me about that I found really fascinating is called Opus, and it's the market leader for, this is really niche, orchestra management software. They've been in business for more than 25 years, and over 250 orchestras worldwide use it, from the US to Australia and China. So how about that for an enterprise segment business?
I loved hearing about the company. Generally, if you go through their portfolio and you look at you often say niche businesses, but then you think about what does it actually mean? But this is one example where this is the company we're talking about, an orchestra management software company. And that's one where, they have customers in the entire world. I mean, 250 orchestras, if you think about it, is a whole lot. There are not that many orchestras in the world, especially the big ones. And again, it's a good example for another comparison to Dranstime. I mean, in my episode, I mentioned how the markets they enter by buying the market leader are very attractive for the first mover, but they usually are not that attractive for new entrants. Now, I'm not an expert on the orchestral market in this case, but I would assume this is just such a niche business where the software that you need to use for these orchestras, if there's one big player in there, I don't see how you get enough demand for one or two other big players in this segment, at least not if you want to actually run a profitable business with this.
Maybe I'm off here since you definitely know the European markets better than me, but I could imagine that there's generally this bias toward local software where perhaps even more so in the public segment, but given the different languages and cultures across Europe, I mean, it's possible that you see the same thing in the enterprise segment as well. So, I mean, is that something that you've noticed, this preference for using software built by local companies in a given country in the EU, or how do you think about that?
That's actually a very good point because there are examples like Opus that operate at scale globally, but many companies in industry still have a local bias. I think that's a good thing also for Chapters because it limits competition. I mean, of course, we would also like to see that, the upside potential just gets larger and larger because you expand into different countries and the scale is getting increasingly more. But it also makes the business very stable and predictable if you have your local market and you're the biggest player in that market. And in the enterprise sector, you always have the chance to expand beyond the local customer base. So perhaps you build the tool first for local customers, and then over time, when you're the market leader in that geography and you have by far the best tool, you then expand globally. I think that's what Opus did to a large extent, and I could imagine other companies could take a similar approach, especially with AI simplifying things like translation and customer support. But I wouldn't worry about growth in local markets either. I mean, there's a relationship between wages and software pricing that should be a tailwind for chapters too. I mean, when wages rise, software companies usually they become relatively cheaper. So this naturally makes companies more willing to pay for tools that just automate work, reduce admin tasks, or just help them deal with labor shortages, which is another thing in Germany. It's not only that labor is expensive, you can also just not find enough skilled workers. And that obviously increases the demand for software companies. And you can actually see this in the macro data. In markets where wages rise faster, software spending tends to rise faster as well. So the fair price of software is ultimately anchored to labor costs. And in most European countries, labor costs have increased significantly faster than the rate of inflation in the last couple of years. So instead of the usual pattern where annual prices increase about 2 to 3% in line with inflation, I think moving towards something like 5 to 7% adjustments is totally realistic in the next couple of years, and especially in categories where the alternative is hiring more people, which is more expensive and, as I said, increasingly also just more difficult to do.
Talking about price increases and organic growth, what is the mix between organic growth and growth through acquisitions for Chapters as a company?
Yeah, over the last couple of years, most of Chapter's growth has still come from acquisitions, which makes sense because they're still broadening the portfolio and they're moving from buying all kinds of businesses to software companies only. But now that those pieces are somewhat in place, organic growth is becoming a slightly bigger part of the story. I mean, management is guiding for low teens organic EBITDA growth this year, and double digits is also what they think is achievable on a steady state basis going forward. And that said, Chapters is still so early in its development that I would personally expect more growth still coming from the M&A business. It's just over the last 3 years. I mean, if you look at it, the invested capital has gone from about 70 million euros to over €500 million.